Okay, why don't we get started? We may need to pause and admit some other participants, but we'll get started now. My name is Deirdre Lord. My company is called the Megawatt Hour, and we bring transparency and clarity to energy markets. Really pleased that you all can join us. We originally planned to, talk about the current status of energy markets and 3 ways you can navigate. But as we got into this, we realized that these times call for as many tools as possible. So we're going to talk about energy markets, we're going to update you, and then we're going to try to give you some tools to manage the volatility and the higher costs that we are seeing. I wanted to just briefly suggest a couple of things. One is, I think this talk will last 20 to 25 minutes. And then, if we're finished early, great. I am more than happy to take questions as we go through, because I much prefer this to be a dialogue. I will stop and ask if anyone has any questions along the way. But please don't be shy about jumping in. I'm a New Yorker. I'm used to interruptions and interrupting myself. So I'm more than happy to have you all, just let me know if you have questions. First of all, why are we here? And this is a quote from the International Energy Agency from back in October. The general view is that after really almost a decade of relatively low cost and volatility, we're going to see energy markets, volatility in energy markets for a while now. And this is never good news for consumers. And I think, this volatility took us all by surprise. Some people, have not really had to pay attention until their bills started to arrive in, March, February. So we don't like seeing consumers feel vulnerable and at the whim and kind of will of the energy markets. So what we really want to do is try to make sure that you know what's going on and that you have tools for navigating it, especially as people are considering their budgets for 2023. So what is happening? We're seeing, so this is a graphic from the International Energy Agency that shows regional resources and their prices going back to January 2010. And so this blue line is natural gas in the United States, this bottom blue line. This is coal, the dotted red line. EU gas is this lighter blue line. And then oil is purple. So we're seeing significant increases in volatility, particularly after the last couple of years of relatively low volatility. And we are seeing more of a global market for natural gas. The US is now exporting liquefied natural gas. Europe has become a very important market for reasons we probably all are well aware of. And so we're seeing more volatility and an uptick in cost, which we'll get into in a few minutes. So what we're going to cover today is basically, why are we focusing on energy markets? Why does it matter? What are best practices, as I mentioned, and what can you expect for the remainder of 2022 and beyond? Just by way of background and introduction, I know some of you, I don't know all of you, but my colleague Bob Bright and I have been involved in energy markets and supply businesses since markets opened in 1998. We have an expertise in all competitive markets, but have a real focus on New York State. We've helped prepare budgets and plan and navigate energy markets since the early days. We've done it for our own businesses, and we've done this for countless customers. And so we know a lot about how to navigate these different dynamic markets. And we were involved in navigating and managing risk back when markets were more volatile in the late early 2000s, 2007, 2008. So this is not unfamiliar territory for us, but it is relatively recent. We I think have gotten complacent as an energy industry because we've seen such low prices over the past several years. So first of all, why even talk about this? And many of you are here probably because you've read about the issues, you're paying your bills, you're planning your budgets, but just by way of level setting, setting standards here and levels, electricity and gas costs are going to impact your, in commodity markets, are going to impact your invoice, your bills, what you pay, no matter what you do. So if you go out and buy electricity from a third-party supplier, you're going to be impacted by commodity markets. If you decide you don't want to participate in supply markets, you're still going to be impacted by commodity markets, because the nature of New York State is that we're a deregulated market. Utilities can't, utilities are don't own their generation. They're going out into commodity markets too. So no matter what you do, you're going to be involved in these markets. Energy markets are financial markets. And so it really, you benefit from having financial wherewithal because you will be participating in a financial market when you're buying energy, period. Again, I've made a point of this and I will make it again. We are now in a dynamic and volatile environment that requires more active management. And, the benefit of any ability to lower operating expenses, they won't be lower compared to last year, but any ability to manage them can directly result in, benefits to your organization, whether you're a higher ed entity and you can free up dollars for staff positions or salaries for nurses or whatever it may be. Again, to just set, to level set, I want to make sure that we all have common vocabulary. So this is basically a breakdown of what every customer pays for electricity in terms of broad groups. I'm going to start at the bottom here. This orange bar is power, electricity, and this is paid to the supplier who buys the energy either from generators or even from your utility. And you can buy that in a forward strip or you can buy that on an index. Then you pay your utility for distribution and transmission. You pay, this is highly technical, but you pay an ancillary services cost for, again, that's based on your supply cost as a small component of your supply cost. Then you pay for something called capacity, which is basically, the generator gets paid to stay operable on the peak hour of the peak day of the year. And so all of us customers has to pay for that. And that market dynamic has also changed in New York. So it's important to understand that. And then there are risk premiums and fees that you pay as well. I'll be focusing primarily on power and on capacity because those are the two biggest kind of shifts in the market that we've seen lately. Any questions on this information, on this graphic? Okay, great. So let's shift now to the commodity markets. What has happened? So natural gas, it's important to note, sets the marginal price of electricity. So over the last since about 2014, we've seen that natural gas and power move very much in concert. They're correlated. So we often look to the natural gas markets to understand what is happening in power. And what we've seen in the past is that prices run up as we approach the heating season, meaning winter. And then, gas gets re-injected into storage facilities and we see a decline in forward markets for natural gas. So you can see a little bit of that dynamic here, as we go into the summer, prices come off and then we come up again in the winter. We are not seeing that same kind of dynamic this year. So, we'll go through this, but there's a supply and demand imbalance and also geopolitical events have resulted in persistently high prices, even though we're just really starting to get out of the heating season. Although you wouldn't know it today in New York City, it's what, in the 30s. So in any event, we are not seeing a big benefit from the shoulder season that we typically see. So what happened with the supply-demand imbalance? As we headed into and through the pandemic, we saw real destruction of demand. Prices fell significantly for natural gas, and producers, it was not worth it to producers to produce natural gas. Then we saw consumption return, demand returned, and honestly, producers, I think, are still benefiting from those higher prices, and they are only slowly bringing on more production capability. So we're still in a supply-demand imbalance. We are now exporting liquefied natural gas to Europe. You could see, that the prices for gas in Europe are quite high. We're in a very precarious global geopolitical situation that's also continuing to impact gas production and cost. The other dynamic that has arisen is that as producers begin to try to increase production, they are coming up against supply chain challenges. So it's taking longer for them to reopen and begin more significant production. The other item I would describe to you is, we're getting a lot of information about energy right now. These are two headlines just from this week alone. Are we going into a recession? If we are, gas would likely take a hit, but maybe not for another year. So we're seeing gas at $6.50 now. It might fall significantly in a year. But so this is the commodity here. On the right-hand side, also this week, we see a potential rally in the basis price, which is the transportation cost of gas. So there are offsetting dynamics that can be overwhelming. And so, it can make things very hard to plan. And so I would say, the best advice we would give is get the best available market information that you can when you need to make decisions, and then put your plan in place. And we'll get into recommendations shortly. But, you can be buffeted by different information, and it can be very overwhelming and difficult to make decisions in that context. Just this week, we saw $6 or $7 shift in power prices just in a few days. So we would just advocate, don't try to be, predict everything perfectly or review every last piece of information. Just try to get the best available data when you're making decisions. This is just a way of visualizing when we talk about volatility and higher prices. This is the forward curve. So this is the forward price of electricity in New York City. And this graphic shows how that forward curve has moved from May 2020 through to late March, early April of 2022. So the gray line is the full year 2022. The purple line is 2023. The green line is 2024, and the red line is 2025. So we've seen a really significant increase in the average cost per megawatt hour of electricity in New York City for 2022 and the following 3 years. And so, we're seeing the impacts of that higher cost here in this forward curve. And again, this is very similar across the state. while this shows you just New York City, we're seeing very similar dynamics upstate in Long Island and elsewhere. This is the, so electricity is priced in on-peak and off-peak periods. On peak, you can see here in blue, this is the New York City strip price for April 2022 through April 2023. This is on peak. So this is $123 a megawatt hour, which amounts to 12 cents a kilowatt hour. Off peak, so on peak is 8 a.m. to 11 p.m. weekdays. Off peak is weekends and nights and holidays. And so off-peak prices are about $38 a megawatt hour. So shifting gears now to capacity. Does anyone, by the way, have any questions on those market forecasts, the forward curve, et cetera? Okay. So shifting gears to capacity. Capacity, as I mentioned, is something that is managed by the New York Independent System Operator. And it basically is something that all customers pay through the ISO on our utility bill, on our electricity bill. The ISO then pays generators to keep their steel available, to keep their facilities available for that peak hour of that peak day. And so this capacity is broken into regional costs, let's say. So purple is Long Island, red is New York City, yellow is Westchester, and blue is the New York control area, which is upstate New York, basically. And we've seen a real shift in prices for capacity over the last year. New York City customers have benefited. So we've seen, capacity costs were $8 per kilowatt per month a year ago. They are now in New York City about $1, less than $1. And that's largely because of new transmission lines that have brought generating resources into New York City. It also is probably a result of the demand destruction that we have witnessed in New York City as a result of the pandemic, and a change to how the ISO prices demand. Now, the flip side of that is that customers in upstate New York, in Westchester, are now paying more for capacity than you used to. So, capacity upstate used to be less than $1. And now in the winter, you can see winter is November through April. Winter, you're paying, almost $4 for some months. In summer, upstate customers are paying $5 per kilowatt per month. This used to be, a very, very small component of cost upstate. So there's been a shift there in the costs. So we're going to shift gears now to recommendations. And this is probably one of our strongest recommendations. We often talk to customers as they're planning their budgeting, and we say, how are you planning to budget for the next year? And they'll say, oh, well, we'll take, the last 12 or 24 months and add an inflation adjuster. So we take, our actual unit rate of electricity costs, and we'll just add a 3% adjuster. And that may have worked at points over the last, several years when we didn't have didn't have high prices or high volatility. We do not recommend that now. It's essential to get a forward view if possible. And here's why. This is a graphic that shows the across New York State's electricity costs for the full year 2021, and that's that blue line. And then this maroon area is 2022. So, year to date, 2022, the average cost of electricity is $100 per megawatt hour. That's 10 cents a kilowatt hour. Through March 2021, that, comparative period, the cost was $46 a megawatt hour, which is, 4.6 cents a kilowatt hour. So if you took last year's prices and tried to, even you'd have to put a huge inflation adjuster in there to get even close to what we expect prices to be over the coming year. And I'll show you, our very, very wide range of what we would expect different customers to pay over the coming year by geography. So our strongest piece of advice is do not use the last 12 to 24 months to forecast budgets. It will be terribly wrong. Any questions?
Those numbers exclude the capacity?
Yes, that does not include capacity. Correct, Dan. Yeah.
Oh.
So this is energy and ancillary services.
And it's going as high as $100 a megawatt hour.
Correct.
Without capacity.
Correct.
Okay.
Yeah. So the next recommendation we would have, and we're seeing customers' preferences shift and their kind of risk appetite and attitude around managing these costs now. They're shifting now because we're seeing more of a dynamic market. But the key now is to determine your organization's risk profile. Do you have any appetite for taking some measure of risk? Or do you need to budget all of your costs and know exactly what your costs will be for every kilowatt hour that comes through your meter? And so, customers, we have some customers who have never fixed a single component of their energy cost because their view, and they're probably right over time, their view is that over time, an index will always end up being the lowest cost option because you're not paying someone to take on your fixed price risk or your fixed price a premium. But what that is not going to be the lowest risk option, right? So they're going to withstand significant costs in certain periods. And so this graphic compares over a period of 2 years, the likely cost, the expected cost of an index product to a fixed price product. The index is in red here, and the green shows the fixed price product. So you pay premiums in sort of the shoulder months and in the summer when you're on a fixed product. But what that does is it gets you price certainty in those high price periods when markets are higher, like January, February, March. So, we have found that customers who really, never wanted to take any risk, now when they're faced with fixed prices that are, and this may sound counterintuitive, but fixed prices that are, double what they've paid over the last 2 years, now they're trying to figure out where can I fix costs? Like, do I fix all of my capacity costs now and take some risk in, the shoulder months and only fix my winter costs, things like that, to try to kind of figure out how to navigate these markets. The other thing we would say, and this is a little harder to do, you're never going to pitch this perfectly or time it perfectly, but you all customers out in these markets are always going to be price takers. So when we see volatility, you should be able to be in a position to take advantage of that volatility. So use that market movement to your advantage. Try to figure out, as we mentioned on the prior slide, what your targets are for your budget numbers. Let's say you want to hit a 7.5 cent per kilowatt hour unit rate for the next 2 years. Set that and then try to take advantage of what we believe will be continued volatility in these markets, and take advantage of that. The other thing is we're seeing people look more and more at different terms. So some customers will just do a 12-month term time and time again when they're buying electricity. But what you'll see, and we'll go back to this prior slide, is that if you're really trying to make a budget number and it's tough to do, the more months that you include that are shoulder periods or lower price periods and you lop off winters, you're going to be able to get a lower rate. So look at different terms, and try to use those imbalances in sort of monthly costs to your advantage. Does this make sense? Anybody have questions here? Okay.
Well, just I guess comparing or relating this back to your comment in the beginning that things have changed and it seems predictability is kind of out the window. So how do these two concepts map up?
Yeah, great question. Because we're not seeing, you're referring to when I said we're not seeing this great relief during the shoulder period. We're still, and the fact is that we haven't seen summer prices. So we're seeing July and August are very high right now in forward markets. So we're not seeing, significant relief in the summer period. We are still seeing a pretty big difference between the shoulder months and winter and summer. We still believe that there are ways of, adding more shoulder months into your contract to lower your overall rate. But it does suggest that, you can't assume that we're going to see a big decline in the near term. But I think it does, this kind of market environment calls for more creativity, both in sort of how you price your product, what your product is, and the term that you're looking for. There are some, we are not in the business, we're not traders, we're not market makers, we're an information platform and a really advisor to customers. So we don't try to bet on when the market's going to move. We do communicate with people who believe, and I almost hesitate to say this, but who believe that gas, shouldn't be at the premiums that it's where it is right now, and that there's a lot of emotion built into this, and that we are seeing now a real return to gas storage season, which usually brings a reduction in gas prices. And so without making lots of predictions, I wouldn't be surprised if we saw some real volatility in gas prices over the next 2 months, let's say, or even before the winter heating season. The benefit that we have right now is that we have, a good 6-8 months of time to look at, where the and to see where the gas market goes. So I would say it's not, you can't just put this purchasing decision on sort of autopilot and say, oh, it's going to be great in September, it's going to be great in March or April. But I wouldn't say that every kind of that it's all very predictable, but I think we will see significant volatility, which will create those opportunities. I hope that answers your question. It's a fairly long-winded answer there. The next thing that so this graphic shows you the components is sort of how your delivery, meaning what your utility is delivering to you, your cost that you pay for your delivery to the utility, versus what your supply costs are. And so delivery is in blue. This is over more than a year here, and supply is in orange. And so you can see that typically supply costs are highest in the winter and delivery costs are highest in the summer. Now, what that means, generally, we suggest that you can't really ignore your costs in any period, and if you're gonna focus on energy efficiency investments, it will most likely impact your delivery costs, your peak demand, and your overall energy consumption. But now, now that supply prices are higher and more volatile, it may be an interesting time to look at capital investments in efficiency projects, LED lights, windows. You may find that your paybacks are even more appealing now that we are out of a mode of very low supply costs. And the other fact that we believe is to be true is you really can't ignore your consumption or your costs in either period. It used to be that July to September were the highest supply cost periods and the highest delivery rate periods. So anything that you did to, impact your efficiency improvements in the summer would pay off for supply, but you really can't ignore any of these periods. And finally, our final recommendation is, especially when there's not good news, there's a real tendency to kind of hope it all goes away. And we're just not seeing that. We're not seeing, a return to kind of a year ago when things were quiet and costs were low. So our view is do everything you can to communicate clearly about the circumstances in which we find ourselves, decide with your colleagues, and we advocate that finance and facilities and procurement in all organizations have very open, ongoing dialogue about what is expected, what your budget forecast is, what your expected high and low costs are. We're providing budgets for higher ed and healthcare clients, and we're giving them, here's your expected cost, here's your high, here's your low, based on what we're seeing in these markets. Recommend any alternative actions that help to ensure that you meet your budget and make sure all assumptions are clear. And this gets back also to that notion that you don't want to use the last 12 months for the next 12. So make sure you're clear about what your assumptions are. So we did a webinar for the Colleges and Universities Association of New York in 2020, when markets were very, very low. We never suggest that people just take these numbers and run with them, but we wanted to compare what we were looking at back in 2020 to what we're looking at today. And so what we're seeing is a significant increase. Again, it'll depend on what customers have done in the past in terms of fixing their costs, whether they've fixed any components, when their contracts are coming up. So I would not use these numbers, but we're seeing, we have customers in Westchester who've been paying 6-7 cents a kilowatt hour and are now looking at 9-10 cents a kilowatt hour for supply alone. So, there are significant increases, and it's important to communicate those increases clearly. So we've focused on why discuss energy markets. We've talked about best practices. We've talked about what to expect. And, the one thing I would add is I started out by saying that we've seen a very a correlation between natural gas prices and electricity prices. In New York State, we're starting to see the forward curves for gas and power diverge in the latter years, 2024, 2025. So we're seeing continued high forward prices for power, while we're seeing gas essentially come off, pricing come off. And why is that? It's largely because we're decarbonizing the New York State grid. And so the expectation is that gas will not set the marginal price for electricity in the future. And we're not sure exactly what will. I think a lot depends on, how we transition from a largely, gas peaking market to something else. But
is that divergence in the later years, the people's predictions of when that's happening then?
It's interesting. Yes, but I wouldn't put a month or day on it.
No, but
yeah,
that's what it's.
I think 2024, 2025 is, I remember actually when this reverse happened, when gas first set the marginal price for power. I think it was 2014, maybe a little bit earlier. And so, I don't know that we know exactly when, but that's what the market is telling us, Stan, exactly. So I think a lot of people have had, the luxury of not really worrying about energy costs. Energy was a pretty small component of a business or an organization's costs. I don't think we can do that now. And so I think there will be a real benefit from focusing on and managing these costs. And the next, I would say probably even 6 to 12 months are going to be really critical. Don't use last year's cost to budget for the next year. Communicate clearly. Use markets to your advantage. And then we are very focused on a process around this. And so, our software provides a forecast of energy cost and usage for 3 years, which helps our customers set their goals and strategy and their budgets, then allows them to make decisions about investments and purchasing, and then allows them to revisit that. And so we've seen customers really benefit from a integrated process that has information and data and analysis at its core, not sort of gut instinct and hoping for the best. So we see that as a virtuous cycle. So that is the end. Let's see, we've got a few more minutes. I'm happy to take questions, or you can, have another 20 minutes to your day. But please feel free to jump in if you have any questions.
Let somebody else go. I've been monopolizing. If anybody else does, they can go first, but I have another question.
No, go right ahead.
This, we've been looking at things, and in our totally admittedly amateur appraisal, but trying to take all the inputs we can, looking at these our purchasing program and saying, these next few months are so uncertain, maybe we need to not lock into a long contract now and just do a little extension on what we're doing and take the the crappiest thing we can for just a few months, and not go for 1-2 years, because right now people are building in, our assumption is people build in what the hell, who knows what's going on, and maybe if we wait 3 months, 4 months, things will settle out and you get something that's at least more representative of what it's going to be like. Is that a reasonable?
We see people doing that. And we actually have a couple of customers who did a 2-month agreement a month ago, because they wanted to do that. They wanted to kind of wait and see. So that is not unreasonable. It's just, there's no guarantee that we'll see relief. And
Yeah.
as you well know, and the, what's interesting is the customers who chose to do that short term, and they did a short term index actually. So they did not fix. They said, we're comfortable, you know, with the day ahead rates in
Yeah.
April and May. We'll take that. We've been tracking how those agreements are performing compared to the fixed price quote that they got. And they're, I mean, I hate to even say this, but they're doing well, you know, if you can, but it's risky.
Doing less bad.
Less badly, right? The only caveat I would throw in is that now they're really looking at, oh, well, maybe we should now fix for the next 12 months. And counterintuitively, you know, we've seen the market go up since that March decision was made. So but maybe they'll do another extension for 3 months of index, you know, and see what happens in September. It's not a terrible strategy, you know, it really isn't, because who knows, you know, what will happen in Ukraine between now and then, you know, or there is a lot of uncertainty. Yeah.
I guess the other side of things is that for all we know, it's going to even get worse.
It could. I mean, you can't guarantee that, right?
Now, you lock in now, you will look like a genius in 3 months, you know, so.
That's what, I mean, interestingly, that's what sort of the conundrum that these two, a couple of customers I mentioned are dealing with is, oh, we could have, you know, done something 2 months ago and it would look great.
Right.
You know,
Right.
it's challenging, very challenging, but that's not a terrible strategy at all.
Yeah. Okay.
I'm curious about timing of the opportunities with the volatility. You know, is it worth having somebody? I don't know. I'm not sure you do this. You know, tell us when the volatility is, you know, at our advantage, and to lock in.
We do. The issue is that you need to be ready, you know, to move quickly. So what we would advocate is, you know, you get all of your data and your accounts and your pricing ready, and you get suppliers bidding on them. And then when you're ready, and you have to decide what is advantageous, you know, is a $5 move enough? Are you going to wait for $10? Is it going to, so, you know, you need to have really talked through a strategy. But we are seeing, you know, there was a week in late December that was the best buying opportunity in the last 8 months. And it happened to fall right around New Year's Eve. So I'm not sure anyone was ready to make a purchase then, but you would have been a hero if you'd purchased then. So my view is it is worth doing, because we could see, you know, a $5 or $10 move in a very short period of time. And in fact, that happened this week. And then when Russia cut off we saw the market come back up almost immediately. It's, you know, it's what we used to see is that we would see a decline and it would be pretty steady, Steve. And now I don't think we can count on that.
Right. And I guess that I thought that's what you were saying is the benefit of volatility is that you could get a crazy drop, and if you buy
yes, but you need to be ready. Yeah, exactly.
Right.
Exactly.
Those drops just occur randomly, or is that is that what happened in December? Sort of a
December was, I don't know exactly what caused December, George. Sometimes if the weather, I mean, this is nutty, but there was a warmer weather. This is before we had an invasion in Ukraine. The weather report, you know, the forecast came out, it was going to be milder in the beginning of January. You see a drop, especially around the winter months. I would not say weather is likely to be a big factor. This summer, we'll see wildfires were an issue last, drought in the Pacific Northwest last summer was an issue because the Pacific Northwest had to power their grid with natural gas because hydro flows were down. So, right now we've got all of these factors. We've got, are we going to have a recession? If there's a recession, that would probably mean a drop in prices. Are we going to have a high, drought summer? Looks likely, could be. Is there going to be some resolution in Europe? Are we going to now, lower our LNG exports? So there are so many dynamics that it's hard to say, which will take precedence at this point.
I guess another question, what factors does your program take into account?
We just take the forward curve. So we are just reflecting what the market is telling us. We're not saying, oh, we think, we take weather, today's weather, we update usage with current forecasts, and we take today's forward curve. But we don't say, tomorrow the curve's going to come down $5 because that's not the business we're in,
That was excellent, by the way. Very good.
Oh, good.
Thank you very much.
You're welcome. Anything else? Really appreciate you all joining. And I'm happy to send these slides around if that's helpful.
Yeah,
And
Deidre, I would like the slides.
Yeah, that would be really helpful, actually.
okay,
Yeah,
happy to.
Yeah.
The only other
All
thing I would say is I have our website here, home.themegawatthour.com. We have a lot of resources. We have definitions of, what is capacity. We have lots of articles about, prices and products. So feel free to, to take a look at our blog in particular, because we try to bring as much transparency in every way through that, through our website as well.
Great. Thank you.
Thank you so
Thank you.
much.
All right, thanks.
thank you
Have
very
a great
much.
day. Take care.